Hi, good morning, and welcome to our weekly market update with Morton Brown Family Wealth. I'm Dennis Morton here with Cody Demmel. Cody, good morning. How are you?
Good morning. I'm good. How are you?
Good. So we are coming off a pretty exciting event here in the Lehigh Valley. We had the U.S. Senior Open over at Saucon Valley Country Club. So Cody, you and I were over there a couple times last week. Just one takeaway that I think is applicable to investing. This is my first time attending a live golf event, and the thing that really jumped out at me was you have some of the best golfers in the world, Hall of Fame golfers, Ernie Els, Patrick Harrington, Mark O'Meara, Vijay Singh. The thing about these guys and any professional golfer is not their ability to make one shot. It's to do it over and over again through a round, and then 4 consecutive rounds over 4 days, and then to do it over a career. That consistency and that ability. Like I look at these shots that they would make, or an amazing putt. I think I've done that once, but then the expectation to do that consistently. It's almost like what we encounter as investors when people say, "Can't we just time the market? Can't you just find the right stock and buy?" Yeah. Then go do it over and over and over again, because that's what it takes, right?
Yeah. I think that's a really good analogy, and it's obviously tough to do it over and over and over. And I think when you listen to the news and you have an analysis that says, "Oh, we timed this bottom," but then at the same time they might have been calling the top way before we actually hit the top. It's so tough to do it over and over and over. And the same is if you're trying to stock pick. I mean, when we were back in 2020 and in 2021, everyone thought you could pretty much just buy whatever, and it went up. And I think now, unfortunately, they're seeing that that's not always the case, and it doesn't happen over and over and over.
Yeah. I heard once that when you're trying to get things right, timing matters, but being early and being wrong are indistinguishable.
Yeah.
You could be wrong for a really long time, and then what is that? What are the implications for that? So I think there's just an acceptance that, okay, you just need to do. I've hit perfect 200-yard shots. The problem is it was on a 150-yard hole. You see, you can get it right and still be wrong.
Yep, exactly.
All right, let's dive into some things that we've been observing and some conversations we've been having internally. Let's start off with a piece from Jeff Kleintop at Schwab, talking about recession and saying the risk is in the reversal. And he has the summertime analogy of a shark bite. So talk about what he means by the shark bite and what this chart tells us.
Yeah, so this is a very interesting chart that goes over the last 50 years of the difference between the U.S. outperforming, which is in the orange. So at the beginning of this chart, the U.S. is outperforming, and then the blue is when the international stocks would outperform. And he says when there's a shark bite, they can only open up so wide before it eventually collapse. And you see that in some of these areas. So in 1970s, U.S. was outperforming, but then eventually it started to close again. In the 80s, international vastly outperformed, and then again, it started to close again. And now we're seeing over the past 10, 15 years, the vast outperformance in the US compared to international. And what he was saying, the risk is in the reversal. When does this start to close again? When does the shark's bite close and this starts to reverse?
Yeah. And I think this is an interesting way of framing it, because we think of risk as charts going down sometimes, right? A chart going down, the alarm bells start going off. But he's saying, the risk is that we get to the top of that chart. And I'm sorry, my pointer isn't active here. I'm going to get my technology up to date here. There's my pointer. The risk is that we get up to the top here, and everyone's convinced that trend will continue to infinity, and it just isn't the case. Another thing to point out here is this is not necessarily, when you see the orange outperforming the blue, or the U.S. markets outperforming like they did in the 1970s, it doesn't necessarily mean they were positive. The U.S. markets were not good in the 1970s, but they were better than international. They were a better diversifier. Same thing goes for the decade of the 2000s, where the U.S. had a lost decade. We went from the dot-com bubble bursting to the great financial crisis. So the decade of 2000 to 2010 was not a great time period for the U.S. stock market. So you could still be in stocks, but you had to be elsewhere.
Yep.
And the same applies, and he brings up the same application for different types of stocks, like growth versus value too, right?
Yep, it does. And I think that's one thing to point out here from 2008 to 2000, where we're at today. This obviously looks like international had a very bad return over the same time frame, but they actually had solid returns. We just had a vast outperformance inside the U.S. And then, as you were saying, there's a very similar chart that goes over growth stocks. So a bunch of the tech NASDAQ stocks compared to some of the value oriented stocks. And they have vastly outperformed over the past 10, 15 years. And it's not that value performed negatively over the past 10, 15 years. It's just growth had to really outperform. So the difference between the two is starting to get very extreme.
Yeah, and you see, and just looking at those bars there, those are recession bars. They show like where those inflection points occur, and frankly, that really narrow line you see in 2020, that's that recession was so fast, it almost didn't provide an opportunity for a repricing or resetting. Like that, we just kind of almost bridged the gap, right, over that really short window. So, but you do look at 2008 to 2010, that recession was almost pinpointed on that inflection point where international stopped outperforming. Growth overtook value. There were all these inflection points. So I think that's what we're watching for. There's always something. We try and take an optimistic view to say, what is the opportunity set here? We've talked about the silver linings of higher interest rates a little bit. We're going to talk a bit more about that today. But the silver lining for anybody who's diversified, if you have investments that are outside of the US, small versus large, value versus growth, eventually the puck gets to where it's going. You got to be there a little bit. So if you're well diversified, this is actually one of those silver linings to say, hey, you own some other things that can even do well coming out of a recession.
Yep.
All right. So one of the other pieces we were looking at this week, conversation, Cullen Roche at Pragmatic Capitalism, great blog, lots of good writing there. He wrote a piece called "Things I Think," and I thought this piece was good because the second thing, where we're going to focus, he actually gets called out by one of his most respected writers, Larry Swedroe, who's one of the great factor-based investors and a great writer in his own right, but calls him out for having one of the worst answers he's ever read to a question about returns. So what Cullen writes about here, the things he thinks are whether real returns are all that matter. Cody, let's talk about real returns versus nominal returns, how that plays into bonds. For investors, what does this do for them?
Yeah, so he was talking about do real returns all that is that all that matters, especially in the fixed income space. So the difference between the return we're getting on the fixed income and the inflation rate, and especially where we see in 2022 when we have inflation so high and we're coming off such a low interest rate, the real return is negative. And he's saying, is that all that matters? And then he dives into most people don't buy the fixed income for the real return. They're buying it for the stability of their portfolio. So that was what he was trying to dive into, just that thought process around that.
Right, and this really brings it back. I think there's what's underlying this is the difference in conversation between somebody who's an investment focused person and somebody who's a financial planner. Because if you're talking about investment returns, yes, if your bonds are earning 2%, inflation running at 8%, yeah, you're lagging behind. But if you're developing a financial plan, you're saying, all right, which pool of assets am I going to dip into in the near term if there's volatility? And bonds are typically, especially short-term, high-quality bonds, are going to hold their value better than higher volatility assets. And we don't expect them. We're not asking them to keep up. We know their job is to make sure that there is principal available to meet short to intermediate term needs per the financial plan.
Yep.
And then we have to be accepting of that. I always think of the investment portfolio. If you think of your pie chart, right? I'd rather think of it as like a baseball lineup, like all these people sitting on the bench and saying, I'm not asking my 180-pound second baseman to bat cleanup and hit 40 home runs a year. No, in certain eras that's happened, but everyone has a role to play here, and bonds play that role of not earning 10% and keeping up with high inflation. It's principal protection, right?
Yeah, and he got into it a little more deeper too. That even in the short term, these more stable fixed income can have all the volatility the same that stocks have, and unfortunately, we've seen that this year, not as much as stocks. But normally, we don't see a 8 to 10% decline in bonds in half a year. But that's what happens when we have all the volatility that we've seen in the interest rate hikes and obviously the inflation numbers that we've seen this year, that over the short term, they could still have a little bit of volatility. But if you look 5 years, it normally is a smooth ride, whether up or more of a flat ride, and letting the yield get the returns for you.
Yeah. And he's saying, and I love when people tie this back to why investing is so hard, right? Because it's not just what assets do, it's when they do it. So, for example, if we think of, all right, here's your cleanup hitter, your stocks that are supposed to provide all the returns, do all the heavy lifting, when they're not doing it right now. But if you've been an equity investor over the last 3 years, 5 years, 10 years, they were doing all of the yeoman's work to provide growth in a portfolio in advance of, the crisis moment that we're in today. So, they do the job at different times. And if we expect them to do it during a crisis, it's not going to happen. But that's where we have to be patient. Say, all right, whose time is it to shine? This is where your high quality bonds are going to be doing what they're supposed to do.
I like that. That's pretty good. And unfortunately, probably what the Phillies are feeling right now, Bryce Harper was kind of carrying them. Now he's out. So someone else is going to have to carry it until he comes back and starts outperforming again.
Right.
Hopefully.
Right.
Yeah.
And that's, we're going to go deep on sports analogies. I think, what is our job if you're an investor and you're managing your family's investment portfolio, the financial plan, or if you're an advisor in our shoes, there's the role of the general manager is a really significant one. I mean, you're not. Sometimes we think of ourselves as the player analogy. Am I the cleanup hitter? Am I the quarterback, or whatever it might be? But I like the general manager analogy, because sometimes, a Bryce Harper is going to get hurt. Who's the next person that steps up? Who slides into that role? How do you backfill? Where's your depth? Because not every piece is going to work when it's supposed to. Life happens. So the general manager role is a much more thoughtful analogy for the position of an investment manager or a financial planner.
Yeah, that's good.
All right. So another piece that we found earlier today, we were talking a little bit about, there was a great piece on Y charts about what happens when we get rising interest rates, the impacts here. So they do kind of a deep dive on, just when interest rates rise off of zero, which we've seen twice in the last decade. We had it first coming out of the great financial crisis. Interest rates went down to zero, stayed there for a little while. And then, we started to rise back in 2015. And what you see here on this chart, as Cody's pointing out, you see the Fed funds rate, which was, you see that plummet in 2008 and 9, and then stayed level for a really long time. And then we have the same thing happening now. Cody, talk us through this chart, which shows the impact of, the correlation between a rising interest rates from the Fed and what happened with stock prices.
Yep. So as Dennis was saying, the orange is the Fed funds rate. So in 2008, 2009, it was pretty high. They had to drop it all the way down to zero, obviously, because we went into a recession. So they tried to get the economy going again. We stayed at zero for a long time, and we can see the rise that we've had in the stocks. So the purple line is the S&P 500. The blue line is the NASDAQ, some more growth-oriented stocks. And then the green line is more of the Dow Industrial Average, which is typically maybe has a little more of a value tilt to it. But you can see when they started to raise interest rates in 2016 going to 2019, we still had a positive return in stocks over that time frame. Granted, one thing to point out, and we discussed it briefly before this call, is we were at lower valuations at this point than where we're at today, or where we're at beginning of 2022. And that's why we've probably seen a good sell-off so far this year, is they're trying to price in the slowdown that eventually we're going to see in the economy. And that's honestly what the Fed is trying to do, to tamper the inflation, but they just have the tough job of trying to slow it down a decent amount, but not too much to drop us into a recession.
Right. And it just, this is really an astonishing chart. The more I stare at this, you just think of just how extraordinary the last 10, 12 years have been. 14 years, gosh, the time flies, right? The last 14 years have been so extraordinary. How much of that time has been spent at or near zero interest rates?
Yep.
Which has been a rewarding environment for anyone who's been invested in stocks, a challenging environment for anyone who's trying to earn money on safety, right? Who's trying to buy a CD or savings account or anything along those lines. But you get to these points where when when the conditions change, we get volatility. The conditions changed when interest rates started to go up, so we had this churn. I remember talking to clients in that period. You look at that period kind of from late 2015 to early 2018, and the market was kind of flat there. It's been about 18 months of doing nothing, and people were, why is this happening? I'm in the same place I was 18 months ago, because the market was adjusting to a new set of conditions, right? Adjusting to what does it mean if rates are not 0 and they're 1% or 2% or 2.5%, where we eventually ended up. Once that adjustment happened, kaboom! You got several big years in a row.
Yeah.
So I think that's the point: is that it's not the market doesn't like uncertainty, it doesn't like change, but it adjusts to change. All of these companies are kind of making those adjustments.
Yeah, that's a good point, because if you look, this looks like a very small drop, but that's because if we look at the right side, we were up around 50% from the lows. But if you look how small 0% is. This was actually probably close to a 20% decline compared to when you look at where we're at now. It's just such a larger decline because we went from up over 200 to around 150. But it was probably pretty close to the same actual decline that we saw at that point. Maybe not as large, but it was pretty close. And the same at the end of 2018. The fourth quarter was pretty rough, and we saw a pretty large decline. And again, it doesn't look near as large as what we've seen this year, just because we're at such a larger return overall from the bottom.
Right. It's just, I'm looking at a chart now of the S&P 500, and just it's not up here on the screen, but just to give you a visual. I mean, imagine a straight line drawn from this 2008 period or even earlier up to where we are right now in equity performance. If I told you that we were having that straight line, which is probably 8 to 10% annualized at least, coming from the period 2008 up to now, if I told you that we were going to get to right here but didn't show the volatility, we'd probably take that, right?
Yeah. Oh yeah. I think I think what was the S&P return at the January of this year, before we had the decline, it was like what, 13-15% annualized over the last couple of years. So even with this sell-off, we're still probably around 10% annualized return over the last 10-15 years.
Yeah. And the other thing that's extraordinary about this chart is you just see, imagine when we see zero interest rates, just imagine cash just flooding into the system, right? This is the monetary stimulus, fiscal stimulus and everything else, and just what it did to asset prices, what that allows, especially growth companies to do. We talk about what is the impact of low interest rates. Low interest rates mean high growth companies can borrow at cheap rates and fund their growth, right? When rates creep up, that stops a little bit. That's why you see the NASDAQ falling off. A lot of growth companies are parked in the NASDAQ. That's why you see the S&P 500 outperforming the Dow, more growth exposure in the S&P. So, that level of funding, it's a normal thing for things to get back to, a more reasonable interest rate cycle, but that inflection point. From Y charts, it got other impacts there. So what are some other things that get affected by, when interest rates rise, we start to see from the consumer perspective, what should we expect to see as things evolve?
Yeah, so I think we've all seen the mortgage rates, even if we're not looking for a mortgage, but we've seen it on the news broadcasting that they went from around 3% for a 30-year mortgage at the beginning of this year, I think all the way up to a high at one point of 6.5%. It's dropped a little bit as the 10-year dropped over the past couple weeks. But then, so they discussed mortgage rates are obviously rising when there's expectations for interest rates to start rising off zero. Credit card interest rates potentially could start rising. And then there's obviously the positive things that hopefully we get better returns from the stability that we were talking earlier from the bonds. And then hopefully the CDs start getting some higher interest rates to the really short-term money. Right.
And that takes time to materialize. I'm just imagine that a couple of years from now or a year from now, we're going to look up and just, it's almost like boiling a frog. We won't even notice that the yield is kicking up on a certain piece, and suddenly it'll be just a more natural thing that, okay, we're earning 1% more on our fixed income than we were, because all these short maturities are getting reinvested as they mature, and they're reinvested at higher rates. So I just, Kathy Jones was on Bloomberg. Kathy Jones is the chief fixed income strategist for Schwab. She was on Bloomberg this morning, and the question was asked, what do you do? Like if your bonds are down right now, if you own a bond or a bond fund, what do you do? What are your options? And she said you have two choices. You hold it to maturity and get your par value back. So a bond can do this. You buy it, or a bond fund, it can go down, but as long as the credit quality is good, you're going to get your money back when it matures. So you kind of have that. It's not like a stock where it can do anything. It could go to zero conceivably. If a business fails, it can go to zero. But a bond, as long as the credit quality is good, you get your money back at the end. So that's your choice one. Choice two is that you sell it and buy something that's paying you more. And that's tricky, because there's still, you have to decide, if it's paying me more, why is it paying me more? And it's probably paying you more because it's lower quality or it's longer term. And those come with risks that aren't always palatable for us as investors. So bonds require patience too, just like stocks. But I thought that was phrasing. So let's tie it back. There's one more thing, and Cody, I don't know if you got a chance to spend much time with this, because I posted this one late last night. There was one piece. Sometimes the question that we get is, what can I be doing differently? Isn't there something that would work here? Did you get a chance to look at that piece from Factor Research on defensive and diversifying strategies? All right, so here's what they worked through. They kind of talked about two different buckets of alternative options. Like say you wanted to diversify out of the S&P and do something that was going to be more defensive during a bear market. And they talked about, just security selection. Like, could you buy treasury bonds or low volatility stocks, quality stocks? Could you use an options strategy? Or could you do something that's more of a traditional hedging strategy, like merger arbitrage or managed futures or global macro or something, something you would expect from a hedge fund? The numbers were crazy. So as of this writing, the S&P 500 was down 23%. Treasury bonds down 14%, quality stocks down 25%, options strategies down 12 to 14%. No, I think the only things, and then you get into the hedge fund strategies, even the long short equities were down 7%, global macro down 15%. Really the only thing that was even close to working was a managed futures strategy, which God bless you if you had that, because it hadn't worked in a decade. I mean, managed futures were just, people were bailing on those like crazy a couple of years ago because they hadn't worked for so long. Yeah. And then they're the one thing that is working. So I just thought that was a pretty valuable thing to say. Isn't there something that could have worked? It doesn't appear that that's the case right now.
Yeah. There's a lot of different things that people try to say, this is going to protect the downside in this type of market. But just because it did in the previous downturn doesn't mean it's going to do it this time, because the conditions are so different, and the ways that the hedge funds try to protect the downside are obviously different every single time we have a downturn, whether it's a longer downturn, what we're seeing this year, or if it's a shorter downturn, and then we have a big correction. As you were saying, majority of those strategies that may have a smaller decline this year were vastly underperforming the market over the last 10, 15 years when we had the outperformance. So it's more of, as we were saying earlier, just trying to stay the course, have a diversified portfolio, and not trying to just switch things up all the time, because it's very hard to time the strategy at that time.
Yeah. This all helps to inform the conversations that we have and our development as coaches and advisors for people who are making good decisions. And the thing I hope we can take away from a time like this is just that hard-earned wisdom that, can bonds go down double digits? Yes, they can. Can stocks go down double digits? Yes, they can. Stocks can go down double digits when we have sub 4% unemployment. Yeah. And an economy that was growing at a 6% clip just months ago. Those things can happen. So when we talk about making assumptions in a financial plan, and sometimes we hear people want to kind of price things to perfection, like, why can't I get 8% per year in a 50-50 stock and bond portfolio? sometimes that occurs, but then you can get times like this too. I just think we need to kind of embrace the clarity that comes from a time like this and say, all right, that there are certain things that can happen. There are ways to mitigate that. If you're owning high quality bonds, maybe you're down a fraction of what the stock market is down, but just have some clarity that these things can occur, and it's not, and also give ourselves grace that you didn't miss the boat by not going into some other strategy that would have salvaged it.
Yeah, that's a good point.
Yeah, great. All right, well, thanks for joining us this morning. We always appreciate you jumping on. The questions that we're getting from clients, a lot of what you hear us talking about are things that we're pulling forward from conversations that we have in the course of our weeks. But if there's something you'd like to hear us discuss in a future weekly market update, shoot us an email or give us a call. We're happy to talk it through. Hope these sessions are helpful, and you have a great rest of the week and a wonderful 4th of July holiday.
Bye.